Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. In today's session, we are going to be breaking down dividend investing. So we're going to look at both recent and long-term performance across the different market cycles, and importantly, some considerations to take when investing in dividend-paying companies and ETFs. Now, just as a reminder, today we're not going to be providing you any advice or investment recommendations. As always, our show is all about providing education around investing and around using ETFs for Canadian do-it-yourself investors. So with me today, I have Chris Heakes, Portfolio Manager with BMO ETFs. Good to have you back, Chris. Chris was highly involved in the construction of our dividend ETF methodology, so he's going to be a great expert to have on today. And I'm also joined by Michael Hu from BMO EnvestorLine, who's going to be sharing with us an update and the latest offer from EnvestorLine as well. So stay tuned for that. Before we get started, just a quick reminder to check out our YouTube channel and subscribe to watch any episodes that you may have missed. We have over 100 videos on there now. You can search by topic for something that's interesting to you. And we have over 3,500 subscribers now. So thanks to all of our subscribers. I hope you continue to find our content valuable. So for today's 1-minute update, I've pulled in the latest equity flow numbers. This is from National Bank. And it's showing year-to-date flows by factor or focus. And as you can see here, on a year-to-date basis, cap-weighted has definitely been the clear winner. So these are things like the S&P 500, TSX Composite, seeing the lion's share of flows on a year-to-date basis. But coming in second, if we strip out that sort of catch-all bucket of thematic, we see dividend or income investing. And I don't think that's really a surprise to many of us. These are popular strategies for retirees, not just retirees, for all investors really. And there's no question that dividends, generally make up a large portion of the total return in a portfolio. So investors are definitely recognizing those benefits. Now, before we get into dividends, I did want to start with one of my favorite charts here to look at factors as a whole. And this is showing the major factors relative to the US Broad Market Index and their performance across the calendar years, with the top performers at the top and the bottom performers at the bottom. So it can be a little overwhelming to look at, but what it's really showing us is that different factors perform differently in different market environments. So this is something to definitely consider when investing in a factor approach. Last year, 2021, we can see value and quality were among the top performing factors. This year, we've been in this inflationary market, and dividends have been doing quite well. So, Chris, I'm going to bring you in now. Thanks for joining me. I did mention that dividends sort of make up a large portion of that overall total return, but can you break this down a bit for us? What does that contribution really look like?
Yeah, thanks, Erin, and thanks for having me. Great to be here. Yes, dividends are definitely a very important part of equity return. Like if you think of long-term equity, return expectations, typically 8%, is a number. When you look at historically, S&P's returned about 8% over the long period of time. Dividends have been, depending on the time period, 3 to 4%. So, upwards of almost 50% of the total equity market return in any one year. We know equities are a good source of return over time. And I think what you see in this chart is, it's not just on any given year, dividends are an important part of return, but the real power in investing is the compounding of dividends. So yeah, in any given year, you're going to collect some dividends, but you can see in this chart, as you compound those dividends and reinvest them into equities, that's what can lead to that, much kind of higher growth chart that you see on the blue line, which is a total return chart versus the orange line, which is just a price return chart. So, they're a key component. They're also a great, signal of, the health of a company. Not the only signal, but, many companies with healthy dividends, that can, signal financial stability. That being said, not every dividend is created equal, and I'm sure we'll get into that as we go, but definitely, an important part of return.
For sure. Thanks, Chris. And then from a portfolio perspective, obviously we saw the flows. Investors are flowing lots of money into the dividend space, but from a portfolio construction perspective, what are the benefits of including these in your portfolio?
Yep. So this is, we're gonna, just kind of get right into it. And this is one of my favorite graphs when it comes to dividend investing. What we're looking at is about 32 years of the return of all kinds of companies in the Canadian equity market. And as you can see in the legend below, they're segmented into dividend growers, dividend payers. The middle bar is just the index, so includes all companies. Then on the right side, you have dividend cutters and non-dividend payers. So kind of like I said, not every dividend is created equal, but look at those dividend growers. And, obviously this is what I think a really good dividend strategy should focus on, is quality dividend payers. Certainly it's what we focus on at BMO in our dividend suite. But those dividend growers, so relative to the broad index, as I mentioned, the index returned about 8.3% over this 32 years. Compounded. The dividend growers have offered more return on average, and even the dividend payers are offering more return. But those companies that cut the dividend, or quite astonishingly almost, companies that don't pay a dividend, have not been associated with increased returns. So as investors, we all want good solid returns to compound over time. Dividend companies have offered a way to achieve that. And then on the volatility side, with volatility, being a measure of risk, what's the risk profile of these companies? And again, you'll see those dividend growers and dividend payers, and think like sustainable, high quality dividend payers, not just companies with a high yield. A lot of times you don't want to go for that high yielding company because it's indicative of a future cut coming. But those kind of real high quality companies, you can see they shave a little bit off this risk measure of volatility, a little bit less than the broad market, which is at 14%. And they're a little bit below that. And again, you can see the dividend cutters and the non-dividend payers, carrying a much higher risk profile. So I think, again, this slide, really, demonstrates kind of the power of dividend investing, done the right way, into those high quality dividend growth type stocks. But shows you the benefits that historically they've had on a return, as well as controlling risk.
For sure, a picture tells 1,000 words. And one thing we talk about when we talk about dividend investing often is to make sure that that dividend is sustainable and that those companies are actually going to be able to fund the dividend. You've mentioned that, we don't want to get stuck in these yield traps. Can you walk us through these charts in terms of the overall health of companies? I think this is in Canada as our example here. Can you walk us through this?
Yeah, absolutely. So, great point. And just to reiterate, avoiding those yield traps, I think is critical for success. And what a yield trap is again, that company with a high yield, but they don't have the cash to pay out the dividend. Here, what we're looking at is just the overall health of, kind of the Canadian corporate, equity market, the corporate health on their balance sheet. One is cash as a percentage of total assets. And, you can see, and this is actually similar during COVID for many people, we actually saw the savings rate increase on the personal side. The same is true on the corporate side. So you can see that top quartile companies, so the companies that are the strongest from a balance sheet perspective, they've really increased the cash on their balance sheet. What does that mean going forward? It definitely helps secure the dividend, particularly in the near term. And another ratio, and we do, moving to the slide on the right, or the picture on the right, is the payout ratio. We consider this when we construct our portfolios at BMO. Payout ratio is a great metric to assess how sustainable is a dividend. So, if a company is making $100 and they're paying out $50 in a dividend, and they're doing that year after year after year, then that's sustainable, and that's something that's great, right? If a company's making $100 but they're paying out $150, you know that can only happen for so long. So again, this is looking at payout ratio at an aggregate basis. You can see the historical payout ratio is about 50%. In times of market crisis, that can accelerate, and it did it to some extent during COVID. But you can see where we are now is below that historical average, and the analyst expectations, which are those three kind of blue bubbles to the far right, are kind of more towards the low. So, again, corporations are generally in very good health, and I think when you can add a screening that also helps get you more into that top quartile of companies, then that can, they're even more healthy from an overall perspective.
Great. And I sort of want to take a beat and talk a little bit about share buybacks here, because they're often sort of spoken about in the same breath as dividends, and there are some similarities for sure. And some dividend strategies do consider companies that use buybacks. But when we talk about dividends, of course, we're talking about cash payments, monthly cash payments, where buybacks generally are reducing the number of shares outstanding, which is going to in turn increase an investor's ownership and therefore their earnings per share. But there were some recent announcements, Chris, this year on taxing share buybacks, both in the US and in Canada. Can you give us some thoughts on what this means to buying back securities as a way of returning shareholder capital? And since this is going to be implemented in the States starting next year, are there strategies or sectors that'll benefit from this in the short term?
Yeah, so just a little background on that. I believe the US has proposed a tax of 1% on share buybacks. Like you said, very well, it's kind of another form of a dividend, but coming through the capital base of the underlying company. So by buying back shares, that makes other shares more valuable. So it's something you do see quality dividend companies often do a bit of both, buybacks as well as dividends. But yeah, with the 1% tax, I think what you're going to see is, companies will still do buybacks, but they'll be mindful of that. Most companies run their businesses to maximize value for shareholders. So, they have to take into account, am I going to do my investors more good by giving some dividend or more good by doing a buyback? And there's reasons to do both. I think you might see buyback activity come down a little bit because it's just natural. If someone makes something more expensive, you tend to see a little bit less demand. But it's going to be, on the other side, it's going to lead to probably higher dividend payments and tailwinds on the back of dividends. A couple sectors that I think could really benefit, and we've seen it already, is energy. And I think we got a question on energy at the back end of the presentation from one of our listeners. But these companies are flush with cash, very sustainable. Obviously, it depends on the level of commodity prices, but they're flush with cash, and you've seen significant dividend growth, special dividends, buybacks, and all of the above this year. So I think you'll continue to see that, with energy prices kind of finding a level at a higher rate than where they had been the past few years. So that's one sector. And, just in general, I think consumer sectors, probably consumer staples, there's strong areas of the economy that can withstand challenges, maybe macroeconomic challenges. We'll still likely see some dividend growth. Some tech companies as well, the Apples, the Microsofts of the world, they're paying dividends now, but listen, they've got a whole lot more cash that if they wanted to, they could pay higher dividends. So I think over time, that'll definitely be a sector where you'll see more mature companies paying more dividends, and perhaps, a little bit less on the buyback side, but still, returning, giving end investors higher amounts of return.
Okay, good to know and good to be aware of there. And then, the other story of this year is, of course, has been inflation. Can you talk a bit about how a dividend strategy performs in this type of environment?
So, short answer is performed very well. Dividends in general have performed very well the last kind of 12 to 18 months as we've been tackling, this higher inflation. One of the dynamics you've seen in the market is companies that are more growth oriented, so more think like an NVIDIA, video chips or tech companies, they've been under pressure because a lot of their return is out in the future. As rates have gone up, future cash flows are impacted more from rising rates than current cash flows. So you've seen growth suffer, but on the other hand, dividend companies like the ones we're talking about, they're companies that are more rich with current cash flows. They've been less impacted by higher inflation and rising interest rates. And that's consistent with kind of the research we've looked at. And if you want to research, what performs well in a high interest rate environment, I mean, you really have to go back and look at the 70s and the 80s for any kind of persistent environment that looked like today. But back then, dividend companies as well outperformed during that period. So, you can see this in the chart where dividend does have, outperformance actually in both falling inflation and rising inflation. But I think the more compelling data point is really in a high CPI environment. So when CPI is north of 5%, that's been associated with better performance from dividend paying companies. And, we're definitely seeing it, continue this year.
Okay, thank you. And then when we look at dividend ETFs, of course, there are many, many out there. Each ETF provider has a few for sure. And at first glance, you might think that they're all the same names typically, but in reality, they can be quite different in terms of the underlying methodology. So as always, it's important to check under the hood and understand, what the strategy is, and of course, what it's not. And this illustration is from our comparison tool on BMOETFs.com. And it's just showing a number of different strategies that I've pulled at random, and you'll see that the performance can vary across offerings quite a bit in different time periods. So consider things like the weighting methodology. Those are going to play a role in these differences. Any sector caps, of course, screenings on the quality of the company or sustainability of the dividend, and in terms of the growth rate of the dividend as well, are all going to play a factor in that. So make sure you're understanding how that portfolio is built. And Chris is here, so he's going to walk us through how our dividend ETF methodology is built, and that'll give you an idea in terms of what you should be looking at when comparing against others too, I think. So go ahead, Chris, how do we build these?
Thanks. And, again, the focus is really on high quality blue chip type companies. That's what we're after. We're not just trying to go for high yields, because like we said, and like we saw, just a straight up high yield, 6, 7, 8, 9% yield is often associated with higher risk. That's not what we want in our dividend portfolios. We want added income, but we want to control risk, and we want to, ideally buy and hold companies for years, if not decades. So the focus is on blue chip. So whether it's in Canada, US, or international EFI markets, we start with a large cap universe to select from. We're looking for companies that have a positive or at worst flat 3-year dividend growth rate. So again, we're looking for those dividend growth and dividend payers. We're not looking for dividend cutters in this portfolio. So they have to be growing or maintaining their dividend. Then we look at the sustainability of the dividend. So, taking that next level look at payout ratios and all this information of how we do it's on our website. But we look at historical as well as future forward-looking payout ratios. And again, we're looking for those companies that are sustainably paying out like 40, 50% payout ratio, totally fine. 100% plus, starting to be risky. 100% plus is typically a company that we're not going to invest in. So we're looking for sustainable and high quality companies with sustainable payout ratios. And then we have a target number of names in each of our portfolios. So for example, in Canada, it's 50 names. So we're looking for the top 50 companies, and what we weight by is total dividends. And total dividends is taking the dividend yield times the market cap of the company. So you get a bit of a blend approach. You get the access to higher yield, and we're only selecting ones that we think are blue chip and high quality. We got that, so higher yield impact, but we also get the impact of the market cap, which also further skews the portfolio to larger companies, more blue chip from a size perspective, and helps manage liquidity within ETFs, which is also a great thing. So helps keep the product very liquid for end investors. And so you got a blend of this, portfolio with, as you can see in ZDV, the yields is almost 4.5%. It's about, the index would be somewhere around, the low 3s right now. So you get that dividend bump, but you also, benefit from, a well-rounded portfolio. that you know, has characteristics, you know, it has a tilt to the market cap, so it doesn't look completely different. Risk is controlled, and you can benefit from higher income.
Perfect. And so we have Canada ZDV, we have US ZDY, which is also available in currency hedged, unhedged, and .U or US dollar. So giving you all the flexibility there, and then international ZDH and ZDI hedged and unhedged as well. So lots of flexibility in terms of our lineup as well, which is definitely a benefit. And Chris, can you touch on a couple of the actual names within these portfolios to give the audience sort of a sense in terms of what's making it into these portfolios?
Yeah, so I mean, I keep talking about blue chip and high quality, and I think I think this is kind of a good proof point where you can see it in these, you know, very recognizable, you know, often multinational, very high quality names. You know, a couple of Canadian names that jump right out are the Royal Bank and CN Rail and Enbridge. You know, these are cornerstones of dividend-based portfolios. RBC's yielding 4%. They just reported, had another strong quarter. I mean, I'm a BMO employee, but you have to recognize where where good results are as an investor, and Royal's doing a great job. You know, BMO's in the portfolio as well. Canadian banks in general are a great sector and are a big part of Canada. You know, Enbridge is another, you know, great stock where we see continued demand and a yield, and yet Enbridge's case over 6%, so it's very compelling. You know, a couple of names in the U.S. and international space. You know, Microsoft and Apple, like I said, they're paying dividends now. They can be included in this portfolio, which is great. You know, other household names like Coca-Cola, J&J. You know, on the international side, Nestle. You know, Roche or a Rio Tinto on the materials side. So very recognizable household names, and you know, sometimes boring is good because you know, these companies kind of just, you know, often and you know, are somewhat boring year after year and just kind of doing their thing and chugging along. But you know, it's a great place to be, and it's been shown to help compound return over time. So yeah, this is very much kind of indicative of what we're trying to accomplish, you know, with the types of companies we're investing in.
Yeah, I agree. Boring is good. Now, I did want to highlight, just to close out on the dividend section here, an all-in-one ETF that takes a dividend-focused approach. So this is ZMI, our BMO Monthly Income ETF. It is a balanced ETF where the equity portion of the portfolio is built with our dividend ETFs as well as our covered call ETFs to bump that yield up. Our covered call ETFs are generally built on dividend portfolios, so you're getting that dividend skew in the equity side of the portfolio, and then on the fixed income side, corporate bonds to bump up the yield on that side as well. So this is a great option for investors who don't want to think about how to build a portfolio or put these ETFs together to build a well-diversified portfolio. It is only 18 basis points in terms of its fee as well, which I think is a steal. A lot of these ETFs, the underlying ETFs are covered calls. For example, the MERs or the management fee is 65 basis points. And this is all in 18 basis point management fee, no double dipping of fees. So as I said, a great deal. I also wanted to highlight all of our BMO ETFs are eligible for the dividend reinvestment plan. And this is a question we get all the time, also known as the DRIP program. So this just means that you can go to your broker dealer and register the ETFs that you hold in your portfolio for the DRIP program, and then your dividends will not be paid in cash. They'll be reinvested back into more units of the ETF. And the benefit to you is if you don't need that cash flow, you're just going to get those reinvested. You're not going to have to pay the commission on buying more units down the road as that increases in your portfolio. So wanted to highlight that as well. And that really covers off the dividend portion of today's discussion, but I want to throw it over to you now, Michael. Thanks for joining us. Michael, as I said, is our partner from BMO InvestorLine. So I'll turn it over to you to take away an update on your side. Thanks, Michael.
Thank you, Erin. Thanks for having me here today and speak about BMO InvestorLine. My name is Michael Hugh, Regional Sales Manager and covering the Vaughan North and Scarborough market area. Today at BMO InvestorLine, so we have a two limit offer, and for our self-direct and the vice-direct platform. So on the left, you can see with the self-direct platform, where you open the fund a new self-direct account, you will receive $4.95 equity trade and commission-free ETF for 90 days. And the $4.95 will apply to online and mobile equity trade for 90 days, starting the 5th business day of the following month. To qualify for this promotion, just click the link on the screen and open and fund a self-direct account and enter the promotion code InvestSmart. So with the AdviceDirect platform, when you open at least $10,000 and you fund the $10,000 into AdviceDirect account, you can get up to $2,500. And how to qualify? You click on the link to open the account. The account must be opened before January 9th, 2023, and the promotion code is digital10 and must be entered. And the fund need to be held until the June 30 next year. So the next slide. So when you invest with the BMO InvestLine, so you can trade over 80 Canada's most popular ETF with zero commission. And those ETF cover the broad range of the asset classes, geographies, management style, and popular themes from the Canada's top provider like iShare, Vanguard, and of course BMO ETF. And we select those ETF with the highest trading volume and with the highest liquidity, so providing the option to cover all type of the investor. The full list can be found on our website at the bmoinvestline.com. And next slide. So at the BMO InvestLine, so with both self-direct and AdviceDirect, and we have a powerful and easy to use the online research tool to help our investor to invest. And with the self-direct, you're the pilot. So you do the research, you make the decision on what to buy, what to sell. And we provide you with the powerful online researching tool, can help you to discover the right investment and quickly. With the AdviceDirect, so you have the co-pilot. So you're still in control, but you get additional personalized support and the exclusive tool for you to validate your investment idea. And with the AdviceDirect, so as an investor, so you will receive the personalized recommendation and based on your own investment objective. So for those investors who do not have lots of time or resource, and this can be a game changer, and you can sort through the unique buy recommendation as you can see from the screen, and this can be done for the stock or the ETF. For example, for the ETF, and you can filter by the market, US or Canada, the MER, the yield, the rating, and the categories based on your own preference. So the unique about the AdviceDirect is that you can contact our AdviceDirect advisor team to discuss further regarding those recommendations. And to learn more about the next slide, right? So to learn more about the BMO InvestLine online investing solution, please feel free to reach out to me via my email on the screen to discuss which platform is most suitable for you. And also as a reminder, use one of the promo code on the screen to take advantage of the offer. For self-directed, so use the code InvestSmart when you open your account to receive your exclusive offer. And for AdviceDirect account, use the code Digital10 when you open your account to receive the campaign offer. And thank you.
Thanks so much for that update, Michael. And just an update from our end is that last week we had Kathy Wood on from ARK Invest, and we've launched 3 ETFs in partnership with ARK, all of which have been added to the BMO InvestorLine free commission-free trade list as well. So just wanted to provide that update. Let's turn to the audience's questions. So we had a couple come in this week that I wanted to get to. As a reminder, you can submit these questions on etfmarketinsights.com. If you have one, we'd love to hear it. So the first one, I can take this one. When is the best time to start investing, and how much of my income should I invest? So this definitely depends on your personal situation, but generally speaking, of course, investing earlier is better, so start immediately. The power of compounding that we were discussing is really going to lead to better long-term returns. Longer you're invested, the longer it has to compound. So start as soon as possible. In terms of how much of your income to invest, again, this is a tough one without knowing the circumstances, what you're saving for, when you started saving, how much your expenses are. All these things are going to play a key factor, but many people reference this 50-20-30 rule, where 50% of your after-tax income should go to your needs, and 30% should go to your wants, and then 20% should go to your savings or your investments. So I thought I'd leave you with that on that front, but again, it's going to depend on your individual circumstances. Chris, this is a good one for you. What are your thoughts on the energy sector at the moment?
Yeah, so the energy sector has been very interesting. Globally, we know it's been a challenging year in markets. Energy is just about the only really good sector, the only really meaningfully positive sector. Consumer staples has hung in there as well, I think in Canada, just slightly positive, but the energy sector is up 40+%. Obviously a lot of that kind of initial wave has been made, but we're seeing energy prices being resilient at the upper end. One of the things that I think about is Biden has depleted that strategic energy reserve by about 200 million barrels. He actually came out and said, well, if oil gets to $70, I'm going to start filling up the tanks again. So that's a lot of demand in the market. Generally constructive on it. I think energy is something that, for myself, I like somewhat of a market weight position. If you look in Canada, the market weight of energy is about 17%. In the US, it's maybe 5%. So let's call it for North America, let's call it, in that 10 to 15% range. I do think it makes sense to have, energy exposure. One of the nice things, incidentally, about the dividends is, in all three regions, Canada, US, and international, it carries pretty closely about that market weight of energy. And there's a lot of great energy companies in Canada that, like we were talking about earlier, are really generating so much free cash flow. They're trading at like 4 times earnings. So they're very compelling. That being said, always there's risk because they're so dependent on the commodity price. So it has to be inappropriate for the portfolio. I couldn't, good conscience, say go all in, but I think market weight is a good place to be, and make sure that you have some in your portfolio, because if we do have a continuation, energy is a sector that could continue to offer some benefits. So so about market weight, 10 to 15% would be my thoughts on it.
All right, good. And if you wanted to tune it up a little, ZEO or equal weight oil and gas would be a good sector related ETF that you could add if you wanted to tilt a little bit more towards energy. Okay, so that caps off another great week of ETF Market Insights. Thanks, Chris and Michael. Really appreciated your insights today. Next week, we will be back, same place, same time, and we'll be discussing liquidity in the ETF market. And I'm excited because we're going to be joined by a market maker and an ETF portfolio manager, both of which play a key role in maintaining the liquidity of the ETF ecosystem, so to speak. So we're going to break down exactly how an ETF works from this perspective, and I think it'll be very informative. Jimmy Karam from BMO Capital Markets and Matt Montemurro from our ETF portfolio management desk will be on to walk us through, but I hope you'll join us then. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.